Hi, good evening, everybody. Thank you for joining me tonight. My name is Daphne, and this is the quarterly market outlook for April. If you can hear me, can you please type a Y for yes, please, in the group chat? Yes. Hi, Valerie. Hi, Banhok. Thank you for joining me tonight. Okay, I assume everybody else can hear me also. Okay, so basically today, what I want to do is to give you a lay of the land, how things are going, what's the background, what to expect, because we are in unprecedented waters. So I'll show you some historical data as well, but basically we're in a place where hasn't really happened before in history. So I just want to give you some like facts and as well as some analysis on how to interpret it and how you might go along with it for at least the next 2 months or so. Okay, so we'll get started. First disclaimer, so everything that I say or share tonight is for educational purposes only, not an indication to buy or sell. Okay, if you're going to trade, you can trade at your own discretion. Remember, this is my analysis, so it's not like the hard truth, like it may or may not happen. So just for educational purposes, if you have any clarifications, you want to ask questions, please do so. I will do my best to answer them. Okay, tonight we also have Amos here. So if you all have any like troubleshooting issues, you can ask him and then he will help. Amos will say hi to you in a moment. Okay. All right. So I'm just gonna go through the agenda today. What you'll learn today is basically what are the consequences of fighting inflation. So you know that the Federal Reserve has been fighting inflation since last year. We started somewhere in March last year, and that consists of hiking interest rates. So this may be quite familiar to some of you, and for those of you who are new to trading, this might be a new concept. So I'll explain what it means. And also, everybody is looking and talking about the Fed's pivot. So I kind of want to shed some light on that and also tell you what that means and expectations versus reality, because what the market expects isn't always the reality. And it's good not to get caught in that as well. So where you might find potential opportunities in the market, everybody wants to know what that is. So I will give you some opportunities. It may not be what you expect, but it's good to know. Okay, so now. What are the consequences of fighting inflation? So right now, as you may know, fighting inflation means hiking rates, right? So hiking rates means the interest rate will increase. Now, this is US interest rates because I think most of you here tonight actually trade US stocks. So this is not Singapore interest rates, it's US interest rates. And how does this affect you? Now, for one, if you're trading on the CMC platform, you're trading like US stocks, generally there's a holding cost. Now, that holding cost is actually based on the US interest rate. So the higher it gets, technically, the more expensive the holding cost, and it only increases when the Federal Reserve hikes the rates, right? They might also cut rates in future. People are expecting that, but this is how the holding cost affects you in terms of trading costs, and also in general in the market, how it affects you. I'll go through with you shortly. Okay. So now basically we've started hiking rates, and it's a target rate. So the Federal Reserve, they always give a target rate. So it's like currently it's 4.75 to 5%. They don't give you an exact number. It's actually a range because then the banks, they base their interest rates on that as well. So it's somewhere at or between the range. Okay. Now it could go higher. So we're not at the peak yet, right? The next probable range, as you can see, so this is the FOMC probability. So if you Google FOMC countdown, which is the Federal Open Market Committee meeting where they announce how much they're going to hike or cut rates by, or they're going to remain the same, you will always see this probability. So how this probability can help you is you know what to expect. So probability generally it comes true. So right now we have a probability of about 85.5% of a 25 basis points rate hike, okay, for the next rate hike, which is going to happen in May. Now, usually, if the probability is so high, that's what the market expects, and that's what the Federal Reserve does. Okay, if they do something that is out of that, then you can expect some kind of fluctuation in the market. So, for example, if people are expecting 25 and in May they hike by 50, what's going to happen is usually what we expect to happen, which I've seen happen before as well. They do something, they hike by higher percentage, then the market's not happy, right? you're shocked, and therefore you see a bit of a decline in the market, right? So this could be why the market is declining that night. It's important to know this because you don't want to be like trading something the night before FOMC, and then the night of FOMC your stock declines by a lot and you're like, hey, what happened? It's not so good. It's good for you to know what happens. So generally people don't trade going into FOMC unless you already have an existing trade in US equity. Or if you're a forex trader, sometimes people purposely trade the FOMC, like just before the speech. That's for scalping lah, where the price spikes for like 5 seconds or dips for 5 seconds by a great amount. Generally we try not to do that. That's not so good because you may be in the wrong direction. So that's quite risky. Okay, so this probability can change. So if you check it, so this was as of yesterday when I was preparing the slides and I checked it. It may change leading up to the date. So if you follow my weekly market update, I usually like closer to the FOMC, I'll tell you what the probability is as well. So you can check that as well if you are intending to, if you have trades in the US market. Okay. Okay, so what is this? This is the Federal Reserve, the dot plot, right? So it's what the Federal Reserve officials expect or where they think the rate hikes might go. So I'll just bring my mouse over to here, right, which is 2023. So where there are more dots means that more people expect lah, right? There's a consensus that's where it's going to be. So where there are more dots is about 5.25, which is close to where we're at, especially after the next rate hike. So the federal officials, most of them think that that's the peak. Now that could change again as the days go by, right? But you also see like three dots around like the 5.5 mark, going up to a bit higher to maybe like 5.75. So it is possible that we may have another 2 or 3 rate hikes. Now, these rate hikes could have an impact on your trading because it kind of determines also where the market is going to go, how it's going to react. Now, I'll give you some scenarios later on, so you can see that. So this dot plot you can also Google, right? Now, so what are the actual consequences of all these like rate hikes and how high the rates are now? Firstly, you create a tougher environment for businesses to profit or grow in, because higher interest rates means like the profit that they make, right? Like the money is worth less, right? So $1 last time and $1 now, it's not $1 now, it's not worth as much as last time when the interest rates were much lower. And also they can't really grow because growing could mean hiring more staff. It could mean taking a loan from the bank to expand the factory, to rent bigger offices. So with high interest rates, they might not be growing the business at this stage, and you can already see that, right? Like from tech firms like laying off staff, that's an example of that. So high interest rates increases the cost of borrowing, so people may be less likely to be buying houses at this stage, or if they already have a house, they might be less likely to refinance that loan or take new loans. Right, so it deters people and businesses from borrowing, so that affects the bank, and basically there's not let's say money flows less in the economy, right? So it kind of contracts the economy. And the little comic over there that I thought was very interesting, because I saw it like last week and I sent it to Amos and everything. So basically what you get is there are recession fears. Now, the top half where you see the disinflation balloon. So we everybody kind of wants disinflation, right? They're expecting inflation to go down, but before you can grasp it as it's going down, maybe the recession fears will grasp the economy first. Whether that happens or not, we don't know yet, but it's a possibility. And I thought it was just quite easy to understand, and it's a nice illustration, so I put it on. Okay, so those are the consequences of fighting inflation. And there is one more, which is also an effect or consequence, is that the yield curve has inverted. Now, how many of you know what a yield curve inversion means? If you know, can you type a me? If you don't know, can you type no? Just so we keep it interactive. Sorry, I realize I've just been like rambling on for the last 5 minutes. Okay, so some no, some yes. Okay. Okay, so yield curve, right? So I think I went through this like last year, but that was a long time ago. So yield curve, if you can see on the screen, let me get my mouse. Let's see if I can draw something for you. Okay, draw. Yes. Okay. So basically, if you look here on the chart, so the yield curve, if you look at the light blue line, which is the 2 year, which I'm circling right now, for the 2 year yield, that kind of represents short term. So that's the short term interest rates. So when the Federal Reserve hikes the interest rate, right, the first thing that goes up is short term. This can also be interpreted as economic outlook for, like, let's say the next 2 years. Okay, for example, short-term economic outlook. So usually, right, in a healthy economy, the longer term, which is a 10 year, longer term interest rate should be higher than the 2 year. Okay, so let's say the 2 year is 2.5%, the 10 year could be like 3.5 or 4.5%. That represents a healthy economy that is growing, right? Because near term it's growing, but then as we get further, it grows even more. So that's a healthy economy. In a economy that kind of expects recession, or it's not growing anymore, or it's contracting, what happens is sometimes the yield curve inverts. And historically, when the yield curve inverts, that's when recession happens. That means yield curve inverts means the 2 year interest rate, right? So 2 year, which is now, okay, the 4.178% is higher than the 10 year. So usually when people look at interest rates, they look at treasuries, and the benchmarks are 2 and 10. Of course, in between there's like 5, and there's further ones like 30. But economists and people in the finance industry have decided that 2 and 10 are the benchmarks. Okay, so when the 2 year inverts, so you can see that it kind of has inverted since July. Has the recession happened yet? No, but historically people expect lah, and it kind of makes sense, right? The conditions that we're in now, economy is not growing, but inflation is so high. People can't spend as much, so we do kind of expect a recession to come. Whether that comes or not, we'll talk about it later. Okay. So does that is the yield curve or like interest rates a bit clearer to you now? If it is, can you type a C for clear? If you want me to repeat, type a R for repeat. Okay, have I lost you already? Okay, is it clear? If it's now it's not normal. Okay, so Valerie has a question. Is now normal? No, it's not. So you can see the blue line, right? So from here, the blue line goes from here to here, and all the way it's been above the 10 year. So it's not normal. We are still inverted. We've been inverted for a while since July 22. So that's generally not a good sign. The 2 year generally shouldn't be higher than the 10 year lah. Right now, because we hike interest rates, well, not we, the Federal Reserve hike interest rates so quickly. So the 2 year interest rates has gone very high. So it's generally not a good thing. It's not a sign of a healthy economy. Okay. Cool. All right. So I will move on. Thank you for your responses. And okay, so I will now move on. Okay. Mm, okay, it's not moving. 1 second. Sorry, because I changed the configuration of my laptop and now I can't find my mouse. Okay, all right. So where inflation currently is, I wanted to share something that I came across the other day. So what happened was when the inflation print came out, so year on year, that means you compare to the last year, right? And people were like, oh, but so there are two types of inflation: headline inflation and headline CPI and core CPI. So headlines, I'll explain what it means shortly. But headline CPI basically went down by a fair bit. It went down to like about 5%. Okay, so it's the red line on the chart. And people were like, oh, but like how come the market didn't rally that night? In fact, that particular night, the market, the equity market lah and the index market actually went down. So people are like, oh, but inflation went up by so much. Why didn't the market rally? That's because this was headline CPI. So headline CPI actually includes things like gas, or like oil, for example, and food prices. So the so-called unstable things, volatile components, right? And if you, so next slide, I will show you. Okay, so this is the eight major groups of the CPI that people calculate. So headline CPI includes all of these things. But if you go to core CPI, they actually take out food because food fluctuates a lot. And they also take out energy prices. So energy prices like oil prices, for example, which are also highly volatile. Okay, so this one I wanted to show you is the same chart but slightly different because if you see where my mouse is right now, so we are in March. Okay, we were in March, so the print that recently came out was for the March data. If you compare to March last year, that was roughly a month or so after Ukraine was invaded by Russia, and we were having this all lack of oil, right? Oil shortage, and also the oil prices went up. So there was spike in oil prices. So that's kind of an outlier situation whereby inflation went up. So of course, if you compare this year March to last year March, it has gone down. So I wouldn't say it's real in that sense that it's gone down. So which is why I think the market didn't rally. That's my analysis. And the other important point you want to look at, right, is this black line over here. So black line is actually core. So that means they have removed oil and food from the mix, like energy prices and food prices from the mix. So if you look at the black line, it hasn't actually gone down that much. And in fact, it's actually above, right? It's above headline CPI. That means that the generally stable components of the CPI basket are actually increasing in price, right? Okay, so of course the Federal Reserve looks at like headline CPI as well, but core CPI means that in general things are actually getting more expensive. So that's also not a good thing. So that's where inflation currently is. Yes, the rate hikes are working, it's going down a little bit, but not as much as people think on the surface. So I just wanted to highlight this because I guess this is not something that's well known lah. Okay, so I hope that helps you understand better. So nowadays, if let's say you see in the CMC platform, there's the market calendar showing you CPI coming out, or there's a lot of news about US CPI, then you roughly know how to interpret CPI and which one to look at. So usually, personally, I look at core CPI year on year rather than headline. Okay. Okay, so that was all the lay of the land, all right? So now we are going to get to the Federal Reserve's pivot, and I'll explain why I've chosen to talk about this pivot. So after you know all the background, the Federal Reserve pivot, it's talked about a lot. So what's a pivot? So recently we've just been hiking, 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 hiking. So the pivot is generally known as when they stop hiking, and when they stop hiking, it doesn't mean that they will cut rates immediately, right? So rate cuts means they decrease the interest rate lah. Uh, Generally, historically, if you were trading during the COVID period, that was good for the market, right? But usually when they stop, there's a bit of a plateau lah, okay? So people are expecting the Fed to stop. They are anticipating for it. There's a lot of talk about it. And I know usually when trading, people say don't look at the news, but from last year to this year, the whole market has been a very reactive market. Means something happens, the Federal Reserve says something, then you see it in the market, right? So that's the conditions nowadays. It's a very reactive market. And there's a lot of anticipation for the Federal Reserve to stop the rate hikes and to keep it steady. That means they just keep it at the whatever rate that they've hiked to. So let's say they hike it to 5.25 or like 5.5%, and they keep it there for a while. How long? Nobody knows. Okay. So eventually, usually the cycle is that they will cut the interest rates lah. That's usually when there is a recession. So if you look at my mouse and on the left side, the graphic, right? So again, I saw this on Instagram and I thought it was very a easy explanation. So this is the general cycle. Now, not all these things always happen. So so there were lower rates at first. The economy was weak. That was during COVID. And then after that, they did QE, right? So QE is often known as printing money. So they put out more money, more liquidity into the market, and people start buying assets and stocks, and then they inflate the stock price, right? So then inflation is high, and they raise the interest rates. So we are on the left side of this cycle now. Now QE doesn't always happen. That's kind of a last resort thing. Usually they cut or hike rates first, and then if that doesn't work, I think COVID was a very special kind of scenario because the economy was just not moving and people needed stimulus and money, so therefore they did QE. Right now we're on the left side of the cycle, so the Federal Reserve expects a soft landing means no recession. I don't really think that's possible, and I'll tell you why. So, but first, okay, so there's an expectation because the equity market has kind of been suffering. So equity is stocks lah, okay? It's kind of been suffering. I'll show you the chart in a bit. It's kind of been suffering as the rate hikes have gone further and further and further. But now that the Federal Reserve is expected to slow down, there's been talks about it for like a couple of months now, maybe like about 4 months. So they have gone from, they can hike rates by like 25, 50, 70. So from the point that they've gone from 75 to 50 to 25, you can see that people start to get a bit optimistic, right? So people are like market participants, and you can see that reflected in the trading performance. They start to get a bit hopeful, a bit optimistic. So then the price starts to go up, right? They start to buy. And this optimism could be due to the hopes of a soft landing and also no drastic misses in earnings. So Q4 earnings, so quarter four for 2022 was not too bad. Quarter one is also not too bad, but it's because, right, the bar is so low. Basically people like analysts, they push the bar lower and lower and lower. The expectations is so low. So also because of that, there's no drastic misses. So I think the market is just like, oh, it's okay, everything's fine. Okay. So on surface level, it starts to go up. Unemployment rates are still low at about 3.5%. This could increase later when, let's say, the Feds keep the interest rates stable at a high rate, then people might start to feel the effects. So unemployment rates are still low, but just on an economic perspective, when unemployment rates are low, you're like, oh, there's no recession. In a recession, the unemployment rates will increase. But as of now, people are like, oh, things are going well, so it doesn't seem like there's going to be a recession at the moment. Okay, so I'll show you the chart. This is the chart. I'm quite proud of it. It took me a while to do it. Okay, so if you look at my screen, right, on the left, where there's 25 and it's a red line, so I'll just quickly explain it. Red line is for 25 basis points hike, so that's 0.25. Purple line is 50 basis points, and then blue line is 75 basis points, which is 0.75. Okay. Oh, thank you, Valerie. You love the graphics. Thank you very much. Okay. All right. So 25 from the left. So we started rate hikes on 17th of March. So you can see, right, rate hikes. This one was still increasing. And then as the days go by, the equity, oh, sorry, this is the S&P 500 futures, which means that S&P is a basket of 500 stocks. That's why I like to look at the S&P 500 because it gives you a general expectation or general view or sense of how the market is reacting or where it's going to go. So usually I look at the S&P 500. So as the days go by, you can see that the market is declining, and then they hike by 50 basis points, which is more, which means the situation is more severe, right? So they hike it, and then, oh, people are pessimistic. So it goes down, and then they go 75 basis points. So that was our very first 75 basis points. And this is like not very far apart, right? It's like March, May, June. So it makes people feel like the situation is quite dire. So panic, right? So 75, okay. And then when we hike by the next 75, the market has already started to go up, but that was not because of the rate hike, it was something else. And then by the third 75, it has gone down again. Okay. And the fourth 75, okay, so this is where it started, right? Around September, this is where it started, where people are like, oh, we're going to start decreasing. They're going to go a bit slower because the rate hikes are working and inflation is declining. So there's a lot of talk about doing smaller hikes. Okay, so you see, yeah, the market starts to go up, right? Because people are like hopeful now. Oh, and then when they do it by 50, they're like, okay, initially the market went down and then after that it starts to go back up. So next one, 25. So they're like, oh, okay, it's getting better, right? Because they're hiking by less. So everything is working, it's going great. So you can see that I've drawn a channel here, the parallel blue channel. It's going like this now, right? So what I expect, or how my analysis, right, for the next couple of months, I think like maybe the next 2 months, it'll kind of just keep trading between this channel. Okay, so trading, so if you follow my mouse, you see, trading between the channels like a wave, right? It doesn't always hit the top or the bottom ranks, but that's okay. So it just tends to go just like this. And there's a middle line. So usually if it goes above the middle line, so it's a bit like CCI, right? If it goes above the middle line, then generally people, oh, I short. Then okay, it comes down, then you buy. If you're a swing trader, generally that's how it goes. It doesn't always hit the bottom. Sometimes it's just a little bit, like over here. Okay, but for the next 2 months, I think you'll just kind of be in this channel, or if anything drastic happens, like for example, the bank collapse. Now nobody predicts that. So if something like that happens, then there may be a change. But other than that, it'll either go just along this channel or it might start trading off sideways. Okay, so the expectations, okay, this is not really expectation lah. Okay, it's just that give you a bit of background. And then next up, we have some facts before I tell you what the reality is. Okay. So, but the expectation is that people have this very optimistic feeling that may or may not be true. I don't think it's true, because they think that, oh, we've been through so much pain, so when this pain stops, everything's going to be fine. But that's not always the case. So I wanted to let you know that this, how high the rates are, is like a pain threshold, right? It's like how much pain can you take? So at the moment, maybe people feel the pinch, but it's not to the point where like, oh, they cannot take it. So they can still spend, just maybe not on things like expensive bags or shoes or extra cars. They're still okay with the day to day. They can pay the mortgage because, for example, if the interest rate is 5% and then the bank charges you a bit of a haircut, that means they charge you the extra percentage lah, right? That they make money from. So let's say it's 7.5%. People can still cope with that, right? But if it goes higher and it stays there, then there may be trickle effects because you can, if let's say, okay, so let's say they hike rates to like 5.5 and you are paying like 7.5 or 8% for mortgage, people can may be able to do that for a month or 2 months, but they may not be able to do that for 6 months, right? So if they keep the interest rates high, that's when you may start to see some trickle effects. So when they hike rates, right, it's not like immediately I hike now and then tomorrow I see the effect. Inflation has come down, people lost their jobs. It's not like that. So if they hold it for a period of time, then you may start to see the effects. So what are the effects? You may see like lesser refinancing, like I mentioned earlier, lesser people taking loans or even default on loans, and you may start to see more businesses shrink. It's already started, but you may see more, like some mortar and brick stores being closed, people closing their warehouses. There may be layoffs, higher unemployment rate, etc., etc. Okay, so how and when, right, really depends on how long they're going to hold the rate steady for. Whether it's 1 month, 2 months, 4 months, nobody knows. It differs every time. Okay, and just to show you, so this is the Federal Reserve's dot plot, which I showed you earlier. Now, I have chosen this picture because I think it's the best way to explain pain threshold. So this is an MMA match, right? And there's this thing called a submission lock where you try to make your opponent submit to you. So one of this is a very popular movement called like a choke hold, right? So you choke the person, and now if you are being choked, you may be able to like tahan for like 5 to 10 seconds or maybe 30 seconds if your tolerance is very high and you are in pain. Sometimes they do one on the arm, which could break your arm, so you are in pain. But can you hold it for 5 minutes? Not likely. So this is a example of like pain threshold lah. Okay, so that's what I mean by if they hold the rate steady at a high rate for a very long time, people might not be able to take it, then you see the trickle effects. Okay, so again, I've been rambling for 5 minutes. I'm going to pause now and ask you, do you have any questions? If you have a questions, you can ask and then I will wait for you and I will drink water. Okay, no questions? No question? Okay. Okay, cool. Thank you. And then we will move on. Now, the reality. Okay, so I just need your full attention because this is a bit heavy. So where the yellow bars are, as I'm moving my mouse now, you can see the yellow bars. So we start from the left. Okay, so from the left, and you are looking at the blue line is the S&P 500 futures. The red line is the federal funds rate. So every time they hike rates, that's the line lah. Okay, so we're going to go all the way back to the year 2000 something. Okay, so right at the far left. Now, where the rectangles are where they have held the rate stable. So here you can see that when they hold the rate stable, it basically has a not so great effect on the equity market, okay, which is the blue line. So you can see that when they hold the rate stable, it kind of goes sideways, or then after that, we might like the equities might start to come down. Now, for the second example, around 2007, so that's the GFC lah, okay? I was very young at that time. So the GFC, when they hold the rate stable, they held it stable for quite a long time. And in this case, so you may still see the equity market go up, but then after that it'll start to come down, right? Because that's generally the effect of a recession. The equity markets will come down, and then you can see the Federal Reserve start to hike rates. So when the rates start to go down, then the rate light starts to go down as well. Now, next example is COVID. I would say this is an outlier, but okay, so they already hiked rates before, nothing to do with COVID. They were just doing it because the economy was growing and the inflation was going up, etc. And then so they kept rates stable, right? So this was going up, and then COVID hit. So then, of course, they tried to cut rates to save the economy, and it had like a very bombastic effect on the stock market, right? All the prices inflated. So this is just an example of when they held rates stable, right? And then this next one is the same chart, but I've just added on purple rectangles. So the purple rectangle shows you what happens after they cut the rates, okay? So generally, you already know that when they start cutting the rates, it's usually after recession happens, meaning the equity market is already going down, or just as they start cutting rates, the equity market is going down. So what happens after they cut the rates? So this is actually part of the Federal Reserve's pivot that people keep talking about. Uh, I think people expect from the reactions like in the market and how it trades, people kind of expect that once the rate hike stop, there's going to be a rate cut, or maybe they think that the plateau will be actually, so when they hold rate stable, will be quite short. So they are expecting a kind of a repeat of what happened in the COVID period, because that's also a recency thing, right? It happened recently, and people who started trading around that time or slightly before, it may be quite impressionable. They may be quite impressionable, so they may associate rate cuts with, oh, the equity market is going to balloon, right? But again, there was an outlier. It might not happen the same way or again or by that much. So if you look at the purple rectangles, when they cut the rates, okay, so rate cut, and then they hold the rate stable, right? It only starts to kind of like go up like after that, or it can also so if you look at this part, right? So it only starts going up after or when shortly after the rate cuts stop. Okay, so when the rate cuts stop and the rates are held stable at a low rate, then the equity market starts to go up. Again, why this is dangerous about what you're going to do or what traders are going to do after the rate hikes stop and when the rate cuts happen is because you don't know how long rates are going to be held the same for. So, for example, if let's say the rate hike stopped and you decide that, oh, okay, now I'm going to buy in because I'm expecting, rate cuts to come in and like the equity market's going to balloon, so I buy in. Now, if they hold rates stable for a very long time and recession starts, that's not great, right? Because you lose money and you don't know how long they're going to hold rates stable for. And when they start cutting rates, based on historical data, the equity market will fall some more, right? So it goes down, 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 down. And only when they're done with the rate cuts, then you start to see the equity market going up. So how long is that going to take? Nobody knows. It could be months, it could be years. So just a heads up that when a pivot happens, maybe try to be a bit more cautious. If you want to like kind of make you want to predict something and you think you are correct, you can go in at a smaller position. You don't have to be like, oh, I go all in, because you're so sure. Now, that generally is not great lah. Okay, don't go all in. You can always put test trades a little bit, and if it's wrong, of course, please have a stop loss in place when you're trading CFDs. So this is what I wanted to explain. I hope it was clear. Oh, sorry, you have questions. Okay. Why ask this question? Is the Federal Reserve hiking again? Yes, likely. So there's about 80% plus probability that next month, 3rd of May, they are going to hike by another 25 basis point. Sorry. Yeah, 25, right? Yeah, 25. So 25 basis points means that it will bring the target rate up lah. Okay. People are speculating that it's the last one. Whether it's the last one or not, I don't know. We will see. But there should be another one at least coming. Okay, that might change, but as of now, the probability is quite high that there'll be another 25 basis points hike. Carol's question: if recession is bound to happen Q3, Q4, the rate will likely be decreased. Yes, could be, but it may take a while. It may not be an instant thing. So if recession hits tomorrow, it's not like they're gonna cut the rates tomorrow, right? And also, if they react quite quickly and they cut the rates, usually when they're cutting rates, so you can see from here, right? For example, here, where my mouse is, you can see that when they're cutting rates, the equity market is also going down. And then even in COVID, when they're cutting rates, the equity market is also going down. Only when they stop and they hold it for a period of time at a low rate. So COVID was about 0.25. So when they hold it low for a period of time, then the effects start to come in, right? So that I hope that answers your question, Carol. And then Valerie's question is: equities go down when interest rate is down, and vice versa. When the rate is stable, equities go up. Okay, so there are actually two parts to the answer lah. Yes, when the rate is stable, generally yes, provided that the rate is low. So let me get my drawing tool. Okay, so you can see, right, that when they hold the rate stable and the equity market goes up, right? So they hold the rate stable, equity market goes up. Generally, the rates are quite low. See, it's very near to like 0.25 or close to zero. So the rates should be low. If they hold rates stable and the rates are high, that's an opposite effect. Then in that case, usually the equity market will go down lah. Okay, so yes, if the rates are low. All right. Okay. And interest rate goes up and bond price will go up. Okay, Janice, very good question. Actually, this one comes out in the opportunity section. So this one I explain later. Okay. That's bonds are actually part of the opportunities for this webinar. For Inghwa's question, how about QE and QT? You think they may have an impact? Yes, I completely agree. I think QE and QT definitely has an effect. So for those of you who don't know what QE and QT is, QT is quantitative easing, meaning they make money more accessible. Okay, it's something to do with the buying and selling of bonds by the Federal Reserve. But QE generally means the layman term lah, is that they print money. They don't print actual money, they just increase the amount of funds that are going around in the market. Okay. So when they do quantitative easing, it is one of the tools that they can employ during recession. So when recession happens and the economy is not good, generally the government or the Federal Reserve, right, they have a couple of tools. One of the tools to make some changes in the economy is rate cuts or rate hikes. In recession, it will be rate cuts or quantitative easing. That's another one of the tools that they can use. So in COVID, they did a lot of quantitative easing. Market went up because money was easily available. They actually made it easier for people to like borrow money, take loans, and to grow the business, things like that. Okay. So QE would definitely have an impact, but QE is usually like a last I lost the word. But it's like a last resort. So last resort kind of thing. Usually they try to do a rate hike or cut first before they do any form of QE lah. Okay, QT also. I think QT may be happening in the background at the moment, but it's not like full on. But usually when QE or QT happens, then I'll release another video telling you how it affects lah. But at the moment, I think the thing that impacts the market the most, or like the easiest to see, or the most direct impact, would be the rate hikes lah. Okay. Inqua, does that answer your question? Okay, so QE and QT definitely does have an impact as well. It's just not something that they're doing at the moment. Okay, cool. All right, so I will go on to the next slide. So after telling you all of this, right, there are actually two schools of thought happening in the market at the moment because everybody is waiting for this pivot so they can do something. So what are they going to do? Oh, I have lost my mouse again. Sorry, 1 second. Okay. Okay, so there are two schools of thought. One school is that you sell the last rate hike. Sell means you short lah. Okay, so once they do the last one and it's confirmed, you short the rate. You short it. Why do they do that? Because some people think that okay, everything's going to go down now. Okay, so all the equities are going to go down. So therefore, they think you should sell the last rate hike. This is the more unpopular thought school. So I think the majority would belong to the green scenario, which is buy the last rate hike. So because as I showed you earlier, right, you could see that the channel is already going up. So people are quite optimistic. They are waiting for all the rate hikes to be over. So there are many people who think that once the rate hikes are over, the market should rally a little bit, right? It should go up a little bit. So there's a school of thought that says you should buy the last rate hike. Now, so which one is more probable? I can't tell you. Honestly, I don't know which one is more probable, but we go by facts lah. Okay, so scenario one, as per the historical data, right? If equities start to decline during the rate plateau, so this belongs to sell the rate hike, last rate hike. So equities start to decline during the rate plateau, as I showed you earlier. And once they stop, right, and this time they are holding interest rates at a very high level. So let's assume 5.25, 5.5. If they hold it, then you start to see the trickle effect, right? So once there's less spending and businesses shrinks and there are layoffs and they start closing stores and people have jobs, then you start to see the trickle effect, which is not good for the businesses. So equities, so businesses have stocks, right? In general, generally speaking. So these stocks will start to decline. And if that leads on into recession, then it will decline some more. So there are some people who think, okay, once they stop hiking, you should short the market. Now, generally, yes and no, because it's not like it'll immediately go down. Sometimes it goes up, it goes down. So, but this is just one general school of thought. The second one is, okay, so inflation, second one is buy the last rate hike, right? So when you buy the last rate hike, the logic behind it is that, okay, so it plateaus, right? And after that, because you hold interest rates high, the inflation gradually decreases because it's a trickle effect again, but the optimism remains. So in that channel I showed you earlier, so people are expecting like, oh, okay, it's getting better. And oh, inflation is decreasing, even better. So it keeps going up. So the optimism is there. And the equity and index markets continue to benefit during this adjustment period. If recession hits later, then that's a different story. Then maybe the equities decline later. So this is more of a short-term thing, like after like maybe a month or two after they stop the rate hikes, then what happens? Okay, so there are these two scenarios. Any questions so far? No, okay. Okay. All right. So, we're already at opportunities. That was fast. Okay. So, what you want to know, because obviously, like, I cannot tell you, I also don't know. Okay, nobody knows. All right. Anybody who tells you that they absolutely 100% know what's going to happen, that's probably not true. Um, they may or may not be right. But okay, so scenario one or two, nobody really knows. But where you can look for opportunities. So it's okay to still be trading US stocks, because if you are trading a basket like a S&P 500 or like the Dow Jones or the Nasdaq 100, you need to spot week to week, which is why I'm not giving you any like oh, it's going to be here like next month. I don't know. I can tell you week to week lah. Okay, generally where the trend is going. So if you follow me on Telegram, you can see my charts and things like that. For Carol's question, yes, it is recorded. Amos, is it recorded? Yes. Okay. So it's recorded. We will send to all the attendees later. Okay, Carol? Can Okay. So, yes, as I was saying, so a month after or two, I won't be able to tell you where it's heading, but I can tell you from week to week, like generally what the trend is. So, you can follow Telegram, right? But we can also look at other opportunities. So you generally want to have diversification, right? Especially if you're trading stocks. Let's say you are making losses in the stock market, maybe you trade somewhere else, you may make some money there. Also, I have a very exciting announcement. So, in July, we're going to be launching CMC Invest. So that's stockbroking, like your Momo Tiger, that type. So you can buy and hold for long periods. So for stocks that you think you want to buy for investment, especially if like a recession hits, and you want to buy them at a cheap price for investment for long term, you can do that in stockbroking, not in CFD. So we'll finally be launching the platform in July. So that's good news. I will let you know when that happens. Okay. In the meantime, we will move on to opportunities. So for opportunities, bonds. So just now there was a question about bonds from Janice, right? Okay, so I just wanted to show you, maybe I'll show you the chart for, okay lah, I taught you through the points first. So for bond prices, sometimes what happens, right, when the interest rates start to get cut, okay, it's an inverse relationship, right? Lower yields equals higher bond prices. But now that the yields are high, the bond prices are low. Okay, so it's an inverse relationship. Now, bond prices can tend to go up in anticipation of lower interest rates, because once they start to hike the interest rates, because it's an inverse relationship. So if the yields go down, generally the prices goes up for bonds, right? In recessionary conditions, also what could make the bond prices go up is the market participants, maybe they might take their, and historically this happens, they might take their money out of the stock market and they put it in safer assets such as like bonds or gold, which are safe havens. That means they are store of value lah. Okay. And for bonds, not in CFDs, like in actual market, like some of you, if like in DBS or UOB, sometimes they sell you like government treasuries or bonds, you can only take your money out at a much later stage, but for an interest. Usually the interest is not high, but it's safe because it's government backed. So similar concept. So market participants tend to flock to bonds, right? In unstable conditions. Okay, so what happens is you might see bond prices go up, and so I'll just show you this. So this, where the blue arrow is basically when people were expecting the rate hikes to stop because of what happened with the banks, right? So you know the smaller banks like SVB and First Bank, there was a bit of a collapse there and a bit of a crisis. So people are like, okay, so the Federal Reserve is not going to hurt the economy anymore. They're going to stop, and people get excited, right? So they are going to expect interest rate cuts, and therefore the bond prices went up a little bit. So this is actually on the CMC platform. It's a Treasury Note 10-year. We also have 2-year. So when you're trading bonds, the good thing about it is you don't have to worry about the coupon or like when you can take your money out, because you are just trading a price. Okay. If you want to buy actual bonds, then that's a conversation for another day. Okay. But in trading, you are basically just trading on the price. You do not own this bond. So you can just trade based on sort of something like price action. Right. So if you are expecting the price to go up in a case of unstable conditions, generally, or when the rate hike stop, generally you will see bond prices go up lah. That's the pattern. Okay, so you can look at bonds as well, right? Okay, sorry, Valerie, does that, sorry, not Valerie, Janice, does that answer your question? All right, so interest rate goes down. That means, so when the interest rate goes down, yes, the bond price will tend to go up. Okay. Okay, what is the ticker chart? Okay, so you can search for UST, sorry, UST Note 10 year, or you can go, your product, not overview, your product library. You can click on treasuries, and then it will all come out, like the 2 year, 10 year, and the rest of it will come out. Maybe we send you a message or email later. Okay, YS. Amos, can you ping YS? And then yeah. Okay, so Amos will get your email from you, and then later we'll send you the list of where to find it. Okay, so you can try out. If you're not confident, you can always try it on the demo account, right? Because demo account, this doesn't fall under stock, so under demo account there is no expiry. Now I understand that it's a new product. It's not commonly traded even in CMC platform. Like, not a lot of our clients trade this, but it's an opportunity lah, so you can see how it goes. Demo account is fake money, so no loss to you. You can try out some things. Okay. Okay, the other opportunity. Now, this is something I quite like. It's called DXY. DXY is the US dollar index. So now the US dollar index tends to be quite reactive. I think I talked about it like a couple of months ago. So when there are rate hikes or rate cuts, generally the DXY reacts first, and I'll show you the chart shortly. So rate hikes, right? When the interest rate increases, it strengthens the DXY, and rate cuts result in a weakened dollar. It's generally that straightforward. Okay, currently it's not so straightforward, but I'll explain why. Okay, so right now it's a situation where it's not just binary, right? Hike or cut. Now, even with the hikes, if they start hiking smaller, so they hike by less, so like they go from 75 to 50 to 25, there's that optimism factor again. So the DXY now tends to fall when they hike by smaller percentages, or when they hold the rate steady. Okay, so I'll show you the chart, then it's always easier to understand when there's visuals. So on the left side, what you see where the red rectangle is, when I find my mouse again. Okay, so on the left side, what you can see is these were the intense rate hikes, where we went like 25, 50, 75, 75, 75. Okay, that was from 17 March to 21st of September. And you can see, right, this is DXY. It's very direct. Once they hike the rates, the DXY goes up. It's just like that. That's the theory, and it's always been like that. It's tried and tested and proven. Okay, but then the moment they started smaller rate hikes, so this was from the last 75, and then 50, and then 25, 25, right? So when they started the smaller rate hikes, people were like, oh, okay, they're going to stop soon, and like it's decreasing in size, the amount that they hike rates by. Then you start to see the DXY decline. Okay, because it's not strengthening it anymore. So in the current situation, it's like that. So when they hold the rate steady, you might see the DXY decline some more, or at least go sideways for a while. But now when there's a rate cut, right? When the Federal Reserve starts cutting rates, the DXY goes down. Okay, that's just how it works, and that's good for you because this one is quite easy, right? And when it goes down means you can short lah. That's one of the things that you could possibly do. So the CMC platform offers shorting, so you can't do this in Invest lah, but you can do it in the CFD platform, which you already have. So you can short, and you can do it for like short periods of time. So of course, if you are like the swing trader type, you can, for example, short from like here to here. You won't be so exact, maybe like you short from here to here, or okay. And in the next scenario, if ever you start to see, so maybe like let's say 5-10 years from now, okay, if let's say you ever see the situation of rate hikes again, you'll remember that, oh, you know what, when the interest rate goes up, the dollar index also goes up. So you can do something with that. And it could be a long-term thing. So this was fairly long-term. I mean, okay lah, not long-term, but it was quite a steady trend. Or you can also trade in terms of like swing, right? Like here to here, here to here, here to here. Okay, so I mean, of course, you can say that. I mean, people will say that, yeah, in hindsight, it's very easy to see. But no, actually, this is the correlation, right, that it has. So rate hikes and DXY, it's a positive correlation. When the hike go up, when the interest rate goes up, the DXY goes up. Okay, except for this situation, which I've explained. So, but other than that, if not next time, you just check for me lah. If you still know me in 5 years, okay. All right. So this is for, oh, I've labeled it bonds. Sorry, this is DXY, not bonds anymore. Okay, DXY dollar index. That's the ticker. That's the ticker. We have that in the CMC platform as well. Okay. Next. Sorry, any questions? For those of you, maybe if you're not so familiar with DXY, because it's not, I mean, it's not equity lah, but it's something you can trade as well. Okay. Any questions? Oh, I let you know. Cannot lah, I'll get into trouble, okay? But I will show you charts and then you make the decision. So if you follow my Telegram weekly, I do put resistance and support levels for you. But if you choose to trade it, it's up to you. Okay? All right. So for opportunities, we also have commodities. Sorry, my voice is going. Okay, so we're the last 5 minutes already. So if you have any questions, prepare them. Okay. So opportunities in commodities. Now, a lot of people, like I don't know, like 3 people in the office told me that commodities are going to go up, but they're being very broad about it. So for commodities, people do expect the play to be in commodities, whether it's like copper or oil or like iron ore, right? I will do some research on that and then I'll give you another video, short video on what it's about, but it's too much to go into today. So for commodities, all. So for all short term, right, you know that OPEC has kind of cut the production. So when there's less supply, generally the oil price will rise lah. It hasn't risen by that much, okay, but if the dollar weakens further, it becomes such that you need more dollars to actually purchase oil. So generally because of that, the oil price becomes more expensive also. So that's what you may see in the short term. In the long term, in event of recession, when the recession happens and rate cuts start to happen, it could also be that all demand decreases. So this is like further out lah. Okay, it's not as immediate as the DXY. But for all in case of a recession, when the all demand decreases, so all price will also decrease lah, because in recession people don't need to, like, let's say, travel as much. Like in COVID, for example, the planes don't fly as much, they don't deliver as much goods, not as much oil is needed, so the oil prices may decrease. The other thing that I actually didn't include in the slide today is gold. So gold actually has been performing quite well, right, of late, like the last 3 months or so, because gold, right, when there is a, like when it's unstable, not even recession, just unstable, like people don't know what's going to happen, generally they start to put their money in gold. So at one point in time during the COVID period, it used to be crypto. So because people thought like, oh, crypto is the new gold. Not anymore, because obviously crypto prices are not doing well, haven't been for a long time, the whole of last year. So gold is the tried and tested and tried and true kind of commodities, whereby if there's a recession or there's any form of instability at all, even now, where people don't really know what to expect, when the rate hike is going to stop, then gold does well. So gold is great. So if you follow Telegram, I have posted gold for like a couple of weeks now. You can have a look at that. So for commodities, gold as well. Okay, so when I do some research on the other commodities and I have a clearer picture for you to look at, then I will share the video with you. Okay, so yes, Telegram group. So Amos has just posted. So if you want weekly updates, because this webinar only happens every quarter, which means every 3 months. So the next one will probably be like in June or July. So that's a bit far out. But if you want like weekly updates, when I look at the market and look at charts and stuff, I usually post them on Telegram. It's free to follow. Once you follow, make sure you enable the notifications, and then you can have a look at all the research and stuff like that lah. And Amos, can you also post our contact details, please? Thank you. Okay, so Amos will post our contact details. You can also message us on Telegram if you have any questions. Reach us there. And we have come to the end of the webinar. Thank you for joining me tonight. Ask any questions. So now it's question time. Okay. Question time. Okay, so why is question? Many analysts don't think there will be a recession. What's my view? Okay, I think it's a very delicate thing. I feel like if they do something wrong in that sense. Like if the Federal Reserve is not careful, like they react too quickly or they hike rates by just a bit too much, they will tip the balance. So whether a recession is going to happen or not, I don't know for sure at this point in time. I think it's a very large, like there's a high possibility lah. It's quite possible because at this point in time, they don't know whether they've hiked rates by too much or not, right? It's when they hold it steady, then you start to see the effects. So I think it's very possible. Possibly if it does happen, it seems to me that it may be like end of Q4 this year. Um, Things might change. I don't know, but as of now, the way I look at the market, I look at the charts, I think it's quite possible lah. That's my view. Okay, but whether it happens or not, even analysts like when they do it, sometimes it doesn't turn out correct. But I will keep you updated via these quarterly webinars. Depending on what happens in the market, it might change. Okay. Um, and we will let you know when Invest launch, CMC Invest, which is a stockbroking platform, but not right now. Okay, because all the details are not like fully ready yet. But we are working on it, so we'll let you know when CMC Invest launches. All right. Sorry, Wise, does that answer your question? I mean, I can't give you a direct yes or no lah. I really don't know. But I think it's a high probability. Okay. Any other questions? Questions? No questions? Okay, if no questions, thank you very much for joining me tonight. I hope you did learn something new. Generally, these webinars, I try to just share what I find in the market and things that are not commonly known so that you might have a bit more background and you don't fall into like traps that people don't see. Okay, so I hope that was helpful and please do join us for the next one as well. We'll send out the invites when they're ready. Join the Telegram channel and I will speak with you and see you very soon. Okay, thank you so much and have a good night. We will send you the recording. Okay.